Welcome to this video, which reviews the elements of PepsiCo's 2017 Annual Report and Form 10-K. From Chapter 1 in your text, we know that U.S. companies that are publicly traded must provide shareholders with an annual report and file Form 10-K with the United States Securities and Exchange Commission, often called the SEC. The annual report and Form 10-K both always include, most importantly, the financial statements. Preceding the financial statements, management's discussion and analysis. Notes to the financial statements, which follow the financial statements, and an independent external public accounting firm's auditor's report. Let's review these elements in PepsiCo's 2017 Annual Report, Form 10-K. So here's the cover of PepsiCo's annual report for the year ended December 30th, 2017. You'll notice that when I show the contents, they'll be a bit more complex than what is shown for teaching purposes in your text. Generally, you'll notice real annual reports are more lengthy and complex, but have the same general elements in similar, but not identical formats. My goal for you is to be able to read real financial statements for companies you may work for or invest in. This is a bit of an art, and it becomes easier with practice. We will look at PepsiCo's 2017 annual report to get you more comfortable with this process before you look at a selected annual report of your own in this class. I say the annual report contains advertisements, pretty pictures of the company's products or services, which we saw on the cover and also within the annual report. They promote the company's charitable and socially responsible actions, and they have a letter from the Chief Executive Officer to shareholders. I say read this letter with a grain of salt, as you would someone's cover letter or resume, as it emphasizes the positive. PepsiCo includes Form 10-K in its annual report. We said that companies that have publicly traded securities must file more information in addition to the annual report with the Securities and Exchange Commission. Publicly traded means they list their securities on a public exchange. PepsiCo does so on the New York Stock Exchange. Many technology companies list their securities on the NASDAQ exchange. The SEC makes this readily available to you and to the public on its EDGAR database. I include a link below, and in Moodle there's a handout about how to use this. Management's discussion and analysis, also known as MDA, precedes the audited financial statements. It gives context, written context and descriptive context to the financial statements. Notice it's 32 pages long. It describes its business, including business risk, in 5 pages. It includes PepsiCo's yearly overall financial results, a description of which, and the divisional results and liquidity in 23 pages, and a description of PepsiCo's critical accounting policies in 4 pages. Even though there's numbers in the management discussion and analysis, for purposes of this class, you will consult the financial statements. Notice for PepsiCo, they take up only 5 pages for the annual report, Form 10-K, but are the main focus. Everything that precedes it or follows it helps to explain them. These are summarized. The notes provide more detail on financial statement numbers, including subcomponents and accounting methods. This is 52 pages, even longer than the management discussion and analysis. The independent registered public accounting firm's auditor's report is only 1.5 pages long. We're going to look at the 4 financial statements described in your text, the first one being the income statement. Sometimes real companies will call this the consolidated statement operations, something slightly different in wording, but you can tell it's an income statement if it follows equation 1. It has revenues from customers, often called sales if they sell goods. Cost of sales is analogous to what they call cost of goods sold expense in your text, one of the expenses. That's the direct cost of the services or goods sold before looking at other operating expenses like selling, general, and administrative expenses. There's often interest expense if a company borrows money. For PepsiCo, this is not part of its day-to-day operations, but its financing. And provision for income taxes. They use a fancy word. Your text would refer to this as income tax expense. It's close to the bottom of the statement. For all shareholders, total dollars of net income for those holding common shares is $4.857 billion for the year ended December 31st, 2017. Later on in the text, we'll describe what this means on a per-share basis for each common shareholder. The second thing we'll look at, your book calls the statement of retained earnings. PepsiCo has a statement of equity which contains the statement of retained earnings, which I highlight, plus additional information. And we'll talk about this in Chapter 2 and in further chapters. The retained earnings section gives us the form of the statement of retained earnings. Beginning retained earnings plus net income earned this year, the $4.86 billion, minus dividends given back to shareholders, $4.54 billion, gives us ending retained earnings of $52.84 billion, which you will see tied to the balance sheet or the third financial statement described in your text. Sometimes it's called the statement of financial position, but you'll know it's a balance sheet if you see it has assets on one side for Pepsi, $79.8 billion, and the other side of it, and the total assets or resources equal total liabilities or obligations to people who aren't owners, plus total equity, the part that belongs to owners. You'll notice that cash and cash equivalents of $10.61 billion on the balance sheet will link to the fourth financial statement at the end of the statement of cash flows. You'll notice that the $52.9 billion of retained earnings agrees with the balance on the statement of equity we looked at in the previous slide. These financial statements link together. The fourth financial statement is the statement of cash flows. It follows this form. It wants to show the change in cash, but why cash changed. So the why of it is the most important thing. It disaggregates the change in cash into cash flows from operating activities, day-to-day cash inflows from customers, minus cash outflows for suppliers, employees, interest, and other. Cash flow from operating activities for PepsiCo is greater than its net income because not all expenses are paid in cash. Investors consider this the most important section of the statement of cash flows. Companies take cash flows and invest them in long-term assets like property, plant, and equipment, and investment securities. They buy and sell these things. Buying them is an outflow and is in parentheses in this section, and selling something is an inflow, a cash inflow, and is positive. Like most companies, Pepsi had a negative cash flow from investing activities of $4.4 billion in 2017 because it bought more property, plant, equipment, and investments than it sold. Cash flows from financing activities include those to or from owners. So when owners give money for stock issued, when the company buys stock back. When companies pay cash dividends, cash goes out. When companies borrow money from lenders, the principal comes in cash flows inflow. When they pay back the principal of the loan, that's a cash outflow. Financing activities for PepsiCo in 2017 resulted in outflows of $4.2 billion. Cash did increase by 1.45 billion. But as we said, the point here is, why did it increase? We had a surplus in cash from operating activities used to finance investing activities, long-term assets and investment securities, and paybacks to shareholders. Of course, there's always a little small foreign exchange effect, which is beyond the scope of this course. You'll notice cash at the end of the statement on December 30, 2017 can be explained by looking at the 1.45 billion increase and the beginning balance, which is the same as the ending balance of 9.16 billion on the balance sheet. This is a handout that I also give you in Moodle, but it shows how the four financial statements tie to one another. The income statement has that form: revenues minus expenses equals net income. Net income from the income statement ties into the statement of retained earnings. That's why we prepare the income statement first. Beginning balance of retained earnings, that's zero at the beginning of a business, but later on it grows because it's the sum of all the earnings that a company has ever made minus the sum of all the dividends it's given back to shareholders. We add to beginning balance retained earnings this year's net income, subtract dividends to get ending balance retained earnings. You'll notice that the ending balance of retained earnings will be on the third financial statement, or the balance sheet. The balance sheet has assets, which are unused resources the firm controls. How it finances this is it either owes money to creditors, debts and obligations to owners, employees, creditors, suppliers, or owners put in their own money, either by giving money by purchasing securities or by allowing the company to keep earnings and not pay them out as dividends. You'll note that cash, which is the first asset on the balance sheet, at the end of the period, you can see this on the statement of cash flows, which you could look at a balance sheet and say, why did cash change, or how much did cash change? But this explains it into operating, investing, and financing activities. So cash at the end of this period from the balance sheet minus cash on the prior period balance sheet. The point of this is why. The notes to the financial statements must follow them. Note 1 for PepsiCo says the basis of presentation, including any subsidiaries consolidated using U.S. generally accepted accounting principles, reported by division as well as for the whole company. There must be a note describing the significant accounting policies used for different transactions and financial statement items. PepsiCo does this in Note 2. Often companies have several acceptable methods within generally accepted accounting principles. Notes detail components of financial statement items. So Note 13 breaks a lot of financial statement items down: accounts and notes receivable, and here inventories. How much of this is raw materials which are not yet ready to sell? 1.344 billion. How much of this is work in process? Kind of like something that the batter is mixed but it's not baked, or it's baked and it's not packaged and ready to sell to customers. And that's a small part, 167 million. And about half of the inventory is finished goods sellable to customers. The independent auditor report is important because why should you believe the company when it makes its own financial statements? This gives us a public accounting firm's independent external opinion on the financial statements. When a company has an unqualified audit opinion, which most companies that trade on U.S. exchanges do, this is the best outcome. One opinion here is on the fairness of presentation of financial position and the results of operations, and whether they conform with U.S. generally accepted accounting principles, which we call GAAP. The second opinion is the effectiveness of internal control over financial reporting. Gives assurance that there are controls that people can't just manipulate the financial statements, break in and hack in or do fraud internally in the financial statements. This was required after the Sarbanes-Oxley Act passed. So, we add an overview of PepsiCo's 2017 annual report focusing on the elements. Please use this as a review before looking at other companies' annual reports. Good luck and get started, Jaspers.